to talk to us about how he's viewing markets. Vinit, exactly a week ago, we were actually doing quite well for ourselves. We were set up very well. India, US was done. India, EU, FTA was also done, and big positive for markets. When you're looking at the budget, well, there were a couple of negatives, but the markets were willing to look through those negatives to a large extent, especially in the week that followed. Talk to us about what's gone wrong now, because we've started to see a huge slide, a lot of it AI-led. How are you viewing it?
So thanks and good morning. So I think I broadly agree with you. As far as the domestic macros are concerned, I am seeing a lot of improvement taking place, not now, but since the last year, we have seen interest rate cuts, GST benefits, income tax benefits. Now the most important, change was the US trade deal, which has also, come in favor. Which was one of the biggest, sentiment drivers for the investors in a way, and for some of the smaller companies in India. So I would say that a lot of the macros are now falling in place. The earnings season is also maybe just about getting over. And when we look at the report card, we see that most of the companies, the downgrade broadly seems to be behind us now. And especially the breadth of the companies, the mid cap and small caps have done well. Large caps maybe in the single digit growth, but the downgrades are behind us. So I would imagine that some of the changes in the macro which has happened over the course of last 1 year, the domestic macros I'm talking about, should feed into the corporate earnings growth over the course of next 1 year, and especially on a low base, I think that should make it pretty much interesting kind of outlook going forward. And combined with what is happening now to the markets because of the global AI-driven narrative, so to say, I think it is making the stocks maybe more reasonable from the valuations viewpoint. So I think it's an interesting setup now. I'm not very negative, and the price points are also making me even more, let's say, positive from investment perspective.
So, Vinit, hi, morning. Based on what you just said, because you're not very negative on the outlook for the market going ahead, and now that we've had a bunch of factors work in our favor in terms of the trade deals, the macros are looking supportive, the budget has been largely okay this time around. What, in your opinion, is going to get this market out of a slump? What could be the next trigger to watch out for going ahead that could lead to a significant momentum for the market in either sides, but at least a move in either direction?
So I think clearly growth is one of the most important ingredient. And as we see last 2 years, if you look at the Nifty earnings growth, we have scaled down from 18-19% growth from 21 to 24, and 25-26 we are down to 7-8% kind of earnings growth, and basically which has sort of subdued the overall sentiment, and on the contrary, we had some of the global AI trades which produced strong numbers, and which is where the money has flown. So I would say that what investors like is to see the growth coming back, and that to me is the most important ingredient to watch for, and which is where I'm saying that maybe next, we have seen maybe the poor form of earnings in the last 2 years, and now we should see them coming back on the behind these improving macros. So that's number one. Number two, I think from the foreign investors' perspective, we had rupee also weakening, which was actually causing a double whammy of sorts. And rupee has also stabilized given the US trade deal is come back. So I would say that a lot of the macros are really falling in place, and we just need that earnings growth visibility to come back, and that's what will drive will be the trigger for the markets to see the direction upwards.
Where exactly is earnings visibility the strongest for you, Vinit, at this point? Because you're obviously looking forward and you're seeing that there is a possibility of earnings upside to start to kick in. Where will the upside be most pronounced versus what valuations look for? Because you want to look at value versus growth. So I'm trying to get a sense as to where you see the most value at this point.
So, see, I think clearly, very simply put, we had the banking sector, which was really lackluster last 2 years, very low single-digit kind of growth. And clearly, because of the low credit demand in the industry, NIMs were under pressure, and all of those are reversing back. And banking really is almost like a 30-35% of the profit pool of the Nifty basket as such. So that itself turning around and maybe showing up about 15-17% growth should be one of the let's say important drivers to the overall earnings. And then we have what has happened last 1 year. All the measures to boost consumption should eventually drive consumption overall, I think, across different categories in different cycles. But broadly, I can say that consumer durables, non-durables have been in a low cycle. And if you if one believes that whatever benefits have been doled out should start leading to, should start driving the consumption growth, I think that's one category where the growth should sort of come back. And then we have our healthcare sector, which anyways keeps sustainably growing at 10-11%. So I think that should continue. IT has seen a pretty poor performance in the last 1.5 year. Now, this is something IT, I would say, is in a very interesting phase right now. It's very difficult to call out how these companies are going to fare. My view is that eventually most companies across the world will have to start implementing or using AI in their processes, in their businesses, and that should lead to improvement in the businesses for the system and integrators like our companies out here. So maybe at some point they will start seeing more volumes of work on the current deflationary risk, which is what is leading them to go down. But I'm not so negative on the IT sector as well. So I think these are some of the components which should sort of drive back the growth.
Okay, Vinit, that's on IT. What is your take on consumption? Seeing that we're seeing a little bit of an uptick coming back in some of the staples, the discretionary categories are also doing well, BPC, consumption, travel, tourism. We've seen some very good set of numbers here. Within the consumption basket, A, do you believe that FMCG staples are now headed for growth, given that we've seen so much mutedness in the past? And B, what do you think about discretionary and where are some of these names headed?
They're more bullish on the discretionary side of the consumption, because I would imagine that as anyways the income levels are growing, people are looking beyond their basic consumer needs. So discretionary is something which should sort of outgrow, and we are seeing in some pockets already that impact is seen. Auto has been one of the big beneficiaries post the GST cuts, and I continue to remain positive on that segment. Auto and auto ancillary taken together. Hospitals have been doing well. Jewelry has been doing well despite the gold price increase. So insurance business have been doing well. So I think we are seeing pockets of decent performers. And then there are all the white good category, consumer durable, electrical category, which despite the real estate sales happening last 2-3 years has not seen a real pullback up. So there also I'm hoping that things should start showing positive trend. So I think within the overall pack, I'm more positive on the consumer discretionary versus the FMCG, so to say.
Vinit, I wonder, I know you touched upon IT for a bit, but I wonder if where does margin of safety really lie where IT is concerned? I know there is uncertainty, everyone knows that. But another 10%, is that where margin of safety starts to get very, very attractive in your opinion? Is there enough there with another 10%? Would it be now? Where would it lie?
So I think clearly in terms of valuations, I would say that the sector today also looks pretty reasonable in terms of where it stands in terms of the valuation, in terms of the underperformance last 1 year. So not so much trying to be cute around another 8-10%, but more importantly, I think the visible signs of business momentum picking up is what I think one would like to see. And my view stays that maybe eventually the companies will see more businesses actually coming out. Today, the noise levels are very high, and hence there is so much of overreaction. And that's what my thoughts are.
Okay. Vinit, on that note, we'll have to let you go. Thanks so much for taking the time out and speaking with us. Always great to be chatting with you. Thanks so much.
Thank you so much.
Okay.